In Chapter 14, we'll be looking at how we audit the finance and investing process. We're going to look at some specific assets, prepaid expenses, intangible assets, and property, plant, and equipment. Now, as we know, prepaid expenses are expenses that are paid before the entity receives the service. Common prepaid expenses are prepaid insurance, interest, and rent. These are normally listed as current assets because the company usually receives the benefit within a year. The inherent risk associated with these expenses is assessed as low because the accounts don't have a lot of complex or contentious accounting issues. So because prepaid expenses are normally processed through the purchasing area, control procedures in purchasing should ensure that each item is properly authorized and recorded. Auditors will gather the information they need about prepaid insurance really by doing substantive procedures such as analytical procedures. You'll compare current year balances in prepaid and insurance expense with prior year. You'll do some ratio computation, compute an estimate of the ending prepaid balance. Also, you'll do the following types of tests of details. Audit testing begins by obtaining a detailed schedule of the prepaid insurance account. The existence and completeness, you'll confirm the policy with the insurance broker, examine supporting source documents. The rights and obligations, you'll do this through confirming policy beneficiary with the insurance broker. And then the evaluation, determine unexpired portion of the policy and insurance expense. So as we said, it's pretty straightforward. Classification, determine propriety of the distribution between any manufacturing overhead and your selling general and administrative expense classifications. That's it. That's it for your prepaid expense items. They're pretty straightforward, as we said. When it comes to intangible assets, remember, these are assets that provide economic benefits for a little more than a year, but they lack physical substance. Some examples for marketing intangibles are trademarks, brand name, internet domain names. A customer intangible could be a customer list, order backlogs, and customer relationships. Artistic, like copyrights. Contract-related intangibles, licenses, franchises, and broadcast rights. Technology, patented and unpatented technology. And then goodwill is an intangible when a company pays more for a company than its fair market value. So these are reviewed on pages 484 to 485. So a company may have one or more of these. Before we go into inherent risk and point out to you that intangibles may need to be tested for impairment annually, depending on the type of it. And if there is an impairment loss, it should be and must be recorded. Give me 1 second. Okay, what kind of inherent risks are associated with them? Well, inherent risks associated with intangible assets raise serious risk considerations, like because the accounting rules are complex and transactions are difficult to audit. Accounting standards require different asset impairment tests for different classes of intangible assets. So there's one complex area. So with the judgment and complexity associated with evaluating and estimating intangible assets, the auditor would likely assess the inherent risk as high, just from the nature of the asset. When it comes to control risk, the auditor should consider the expertise and experience of those determining the fair value of the assets, as well as controls over the process used to determine fair value measurements. including controls over data, segregation of duties between those committing the entity to the purchase and those undertaking the valuation. So we want to see, are those two areas separated? The extent to which the entity engages or employs valuation specialists. Who are they? The significant management assumptions used in determining fair value of an intangible. The integrity of change controls and security procedures for valuation models and relevant information systems, including approval processes. So there's more risk involved with these types of assets than your prepaids. Good. Sorry, I just found out somebody passed away. Okay, I'm going to keep going. Tests of details of intangible assets. The tests of details associated with valuation and impairment of intangible assets are often necessary because the complexity and degree of judgment increase the risk of material misstatement. So it's very important that we're looking at that control side, the control risk and control procedures, because of the estimating and the appraisal and determining fair value. Some substantive evidence is required for all significant accounts, and as noted above, substantive analytical procedures are not likely to provide sufficient appropriate evidence for significant transactions involving intangible assets. We got to look further. 4 assertions are normally considered for tests of details of intangible assets. The first being existence and completeness. So here we're testing for the existence at the time they're acquired. Your primary concern relative to completeness is to ensure entities' impairment testing procedures include all intangible assets. Valuation. This is the most important assertion associated with it, as we said. The initial valuation involves an allocation of purchase price. Once an intangible asset is determined to be impaired, though, the current value must be determined to compute the impairment loss. Then here's where we want to do a lot of testing in determining that value. Is it properly being valued? Are we using a specialist? Rights and obligations. What type of litigation is there regarding these intangible assets? And normally there could be quite a bit. We read the minutes of the board of directors meetings and communicates with the entity's counsel to determine if there is any pending obligation. Do they have a right to have this asset? And classification. The auditor's concern is that the different types of intangibles are identified and accounted for properly. Okay, so these are the areas we're looking at during our substantive procedures. Beyond intangibles are the property management processes. Now we're looking at property, plant, and equipment, and that's the remainder of our discussion. It usually represents a material amount. Recurring engagements, the auditor is able to focus on additions and retirements because everything else is remaining the same. New engagement, you have to verify the assets that make up the beginning balance in PP&E, property, plant, and equipment. The 4 types of transactions that may occur that we focus on are the acquisition for cash or non-monetary consideration, the disposition through sale, exchange, retirement, or abandon, depreciation, and the leasing of capital assets. So on page 489 is one of your favorite things I saw from your discussion boards, the flow chart for the property management process at Earthware Clothiers. So the IT department through the purchasing process is really where the purchase begins, and then we have our transaction file that keeps track of the PP&E, property, plant, and equipment. Specialized property, plant, and equipment is inputted into this program, and a transaction report is created. We want to make sure that it's properly recorded and everything agrees. And we want to reconcile monthly the physical plant information with the ledger, the subsidiary ledger, which flows through to the general ledger, the ultimate balance. So take a read through that and the information on page 489. Now, inherent risk associated with property management. There are 3 inherent risk factors: complex accounting issues, difficult to audit transactions, and misstatements detected in prior audits. Complex. A number of different types of transactions can lead to complex accounting issues such as lease accounting, self-constructed assets, capitalized interest. These types of transactions could make the property management process more complex and have some inherent risk then when it comes to auditing. Difficult to audit transactions. The majority of PP&A is easy to audit. You buy it, you sell it, okay. However, what if there's donated assets or non-monetary exchange or self-constructed asset? This is when we are in more difficult areas to audit. Finally, an inherent risk. If the auditor has detected misstatements in the prior audit, the assessment of inherent risk should be higher. Again, that's our complex accounting issues. So the information involved with determining the amounts is more of a complex calculation from internal sources than it is from an external transaction. Again, difficult to audit transactions are listed here. And then our misstatement information. When it comes to property management process, during our control risk assessment, we're looking at a couple items: occurrence and authorization. So we're determining there's control procedures for the occurrence and authorization of PP&E, and they're normally part of the purchasing process. Large capital assets may be subject to additional controls. Companies should have an authorization table for approving capital asset transactions, and we should be also looking for assets that are no longer in use. Completeness. Usually there's a detailed property, plant, and equipment subsidiary ledger, which includes the following: a description, location, and ID number, date of acquisition and installed cost, and depreciation calculations. Is there key segregation of duties? And this is important. The function of initiating and purchasing the purchase should be segregated from the final approval function. So if one individual is responsible for initiating a capital asset transaction and has final approval, fictitious or unauthorized purchases of assets can occur. This can result in purchases of unnecessary assets, assets that do not meet the company's quality control standards, or illegal payments to suppliers or contractors. So this must be separated. The PP&E records function should be segregated from the general ledger function. So if one individual is responsible for PP&E records and also for the general ledger, the individual can conceal any fraud that would normally be detected by reconciling subsidiary ledgers with the general ledger control account. So you want those two separated as well. Finally, the PP&E records function should be segregated from the custodial or safeguarding function. Absolutely. So if one individual is responsible for the records and has custody of the assets, tools and equipment can be stolen and the theft can be concealed by adjustment of the accounting records. Finally, if a periodic physical inventory of PP&E is taken, the individual responsible for the inventory should be independent of the custodial and record-keeping function. If the individual who is responsible for the periodic physical inventory is also responsible for the custodial and record-keeping functions, whoa, might as well just hand them the store, right? So we want to make sure, this is very important when it comes to assessing control risk. What kind of segregation of duties are there? Once we assess our control risk, we can now plan for our substantive analytical procedures. Some typical types of procedures: compare prior year balances and depreciation expense with current year. Compute the ratio of depreciation expense to the related PP&E accounts and compare it to prior year ratios. Compute the ratio of repairs and maintenance to the related PP&E accounts and compare to prior year's ratios. Compute the ratio of insurance expense, because you would have insurance on certain assets, right? See if your insurance went up and down considerably, and review capital budgets and compare that amount with amounts actually spent. Once we assess, do some assessment of using our substantive analytical procedures, now we could test our account balances, disclosures, and details. So what are we looking for? Completeness and accuracy. So the auditor begins the process by obtaining a lead schedule and detailed schedule of all additions and dispositions of assets. The schedules are footed and agreed to the general ledger T accounts. Then you can trace a sample of the assets to the PP&E subsidiary ledger. On pages 495, there's an example of a lead schedule. To test cutoff, it's normally part of the accounts payable and accrued expenses work. So any vendors and invoices from a few days before and after year end are examined to determine if any assets are not recorded that should be, or are recorded that shouldn't be. As far as classification goes, the auditor must determine that the asset is recorded in the proper account. Repairs and maintenance should be reviewed to determine if any assets are accidentally or incorrectly recorded there. And any material lease agreement should be reviewed so that it's properly classified as operating or capital. When we're testing existence, we want to make sure there's a list of all major additions, and each addition should be vouched to supporting documentation. Major acquisitions, the auditor may physically examine the capital asset. This is often done during the inventory observation. Any major disposition should be vouched to supporting documentation. To test for rights and obligations. In most cases, rights or ownership can be determined by looking at the vendor's invoices and supporting documents. In some cases, the auditor may wish to confirm property deeds or title documentations. As far as valuation and allocation, we're looking to determine capital assets are valued at their cost plus any cost to make the asset operational. They have to test the recorded costs of major new additions. The auditor may recompute manually or with the aid of CAATs the proper depreciation expense. And they must determine for permanent impairment, must test for permanent impairment of long-lived assets. While GAAP requires the comparison of future cash inflows to the asset's carrying amount, this is where it becomes difficult. So the auditor may look to other sources of information to learn about impairments, because it's all prediction, right? As far as disclosures issues, some examples of disclosure items we're looking for: there's classes of capital assets and valuation basis, depreciation methods and useful lives for financial reporting and tax purposes. There's non-operating assets, the construction or purchase commitments we're looking at, liens and mortgages, to see if there's notes about that. Acquisition or disposal of major operating facilities must be noted, and capitalized and lease arrangements as well. So all these items related to property, plant, and equipment must be noted and disclosed. Once we collect our information about the PP&E, we then must, of course, evaluate the audit findings. So the auditor aggregates the likely misstatement and compares this amount to the tolerable misstatement, as they do in other parts of the process. If the aggregate misstatement, of course, is less than the tolerable, the PP&Es are not materially misstated. But if they are greater, as we know, than the tolerable misstatement, we would either require an adjustment of the accounts or issue a qualified audit report. So we're going through the same processes, but just looking at specific assets here. First, we looked at prepaid expenses, which are pretty straightforward. Intangible assets, a little bit more complex. More items that are uncertain when we're going through the audit process, needing to rely on a specialist for some computations and verification. And then a more extensive asset we look at is property, plant, and equipment, which could also have its own complex areas with regards to self-constructed assets, capitalizing interest, or sorry, I keep getting messages. It'll come to me. See that? Oh, lease agreements. See, it did. So that's our discussion on auditing those different types of assets. If you have any questions, please post them or email them to me. And that's it for Chapter 14.